certainly we're seeing just a lot of evidence that perhaps there is a recession already underway, and it just hasn't been acknowledged. But really, kind of the key thing, and I know you've talked a lot about the K-shaped recovery. The top of the K is doing well, bottom not so well. You even brought up maybe it's an I-shaped recovery with
Mhm.
a small I at the top of those that are doing well. But there's just some data here that that's the case, that how really challenged a lot of lower income Americans are, and even kind of middle income Americans. And really, you're seeing more and more of this, how it's kind of working its way up the pyramid and starting to hit people who typically are more insulated from economic declines and contractions.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here for a special edition of Thoughtful Money. This is something that we told you we were going to try to do, and we are going to pilot it here with its inaugural episode. I'm very fortunate to be joined here by David Hay. David, how are you?
Great, Adam. I'm just getting this deja vu all over again feeling for some reason.
For a good reason. I'm going to explain why to folks in just a second. But first, folks, last time David was on, we talked about how he and I agreed that given his power viewing of thoughtful money, it's a great honor to me. I wonder if it's a great punishment or if David is a secret masochist because he watches virtually all the interviews that we do here on Thoughtful Money and is a great student of the key takeaways from them. So in my previous interviews with him, he's done a great job of saying, well, Adam, that's just like what so-and-so said when they were on last week. So we agreed to do a monthly recap with him going forward, of which this will be the first one. And it's a recap in two ways. David, in his own right, great expert, was, I believe, the chief investment officer, if I'm getting this right, of Evergreen Gavcal. Then miserably failed retirement and has been publishing his Substack, his excellent Haymaker Substack. So he's going to update us on the key elements that he sees going on with his macro and market outlook right now. And then there's going to be a part two of this video where he and I will both go through a number of the recent guest appearances on this channel and kind of talk about our key takeaways from them. That one is also good. That part two is going to be introducing another new release here for Thoughtful Money. YouTube has relatively recent released a channel membership program, which essentially is premium content that's available to the YouTube audience. And I have put the little membership, I've activated it, and a couple people have signed up for it. But what I want to be able to do is provide folks, on YouTube who want more content with a little bit more content. So that's what that extra content's going to be. It's going to be this monthly retroactive of David and I looking across the past couple weeks of the month and saying, okay, what were some of the really key things that stood out to us that we think are really worth putting on people's radar? So this video is going to be kind of in a part one and a part two. The part one is going to be public. We're about to kick that off right now. The part two will be available to the folks that have signed up for channel memberships here on YouTube, or if you are a premium subscriber already to the Thoughtful Money Substack, then don't worry, you're going to be sent that part two as well. So one thing to think about the membership is if you just like to hang out in YouTube, that's kind of an extra plus level on YouTube. But if you just want everything Thoughtful Money, just subscribe to the Substack premium service and you'll get everything going forward. Now, David said he's having deja vu all over again for good reason. We recorded this a couple of days ago and the recording disappeared into the ether, and I will take 100% of the blame of that. It was an excellent discussion, which hopefully will perhaps, maybe if possible, even improve upon this time around, David, now that we've had a
I think we
practice
will.
round. But David did a phenomenal job, and he's so kind to have given us so much of his time already this week and come back to do the exact same thing. So David, thank you so much for doing that.
You're welcome, Adam. Anything to
All
help
right.
out the cause. And by the way, just let me sneak in quick congratulations. You've got another great star appearing in October at your big conference, Lynn Alden. So kudos on that one.
Thanks. Yeah, and Lynn, we've got so many great stars this year that I know folks would love to hear Lynn's macro and market outlook. And actually, I'm going to try to get her on the public channel beforehand to share that. But I've had a lot of requests this year to talk more about Bitcoin. Lynn is one of the preeminent experts in the world on Bitcoin, and so we're going to have her do a deep dive on that at this conference. So thank you for noting that, David. All right, well, look, a pretty lengthy intro there. I'll kind of wind down here for a little while, David, because you have a wonderful slide deck that you prepared that goes through much of everything I just laid out. I guess let's get to that as quickly as we can. Anything you want to say before you actually start the slides?
Yes, there actually is, because what I'm going to try to do is to go through a lot of the slides pretty quickly, because we've got different segments, but three of the segments that I particularly wanted to focus on are housing, liquidity, and commodities. And I think they're all kind of related, but particularly the last two. So, but if there's a visual that you want to pause on and have me elaborate more than just kind of a quick, like just a flash image, let me know, and we can do that. Obviously the jobs market is getting more and more attention, and that actually is how we start out. So let me get
kind of by the day, right?
kind of by the day. Yeah, there's been some really, and we'll talk about that, some interesting stuff that's come out here lately. So let me get my slide deck going here. So bear with me. All right, who are those two guys? One's definitely a lot younger than the other one.
And one's definitely more handsome, that guy on the right.
I don't know about that. This is more like how I feel. This guy here, though, actually, for many of our investments this year, we should be celebrating a lot of these hard assets that were behaving in a pretty soft fashion lately have really come alive. So that's I'm not feeling quite as punch drunk as I did maybe a few months ago. But I do think we should give ourselves a pat on the back here for what happened with this jobs number. Because when we last spoke in July, late July, we were both very critical of the jobs numbers that had been reported in June. You remember that?
Absolutely. Yeah, it does. I mean, I don't think we were uniquely alone on that, but we were definitely one of the louder voices, and it's been great validation to see.
Yeah, right after that, that bombshell number came out that has really done like a 180 to the jobs market. And as you alluded to, there's been more data that's come out here even recently that's indicating things are going the wrong way. But let's get into here and look at some of the specifics. We got a couple images from Danielle DiMartino booth. Did you just have her on too? I think you did.
I did. So yeah, I've got some fresh insights even since we recorded, our failed experience a few days ago.
Well, these are again credit to her for this. This is looking at basically layoffs happening in various industries, and it's the important thing about this image is that we're at a recession threshold quite clearly. And if it was on its own, might not pay too much attention to it, but I think it really fits in a mosaic of weakness. And this is 2-month payroll net revisions, and I think this is going to get worse. I mean, from the Fed body language about the number coming out tomorrow, that it's like they're bracing for a really bad one. Now, maybe because the new whoever, I don't know if I think it's an interim head of BLS right now, Bureau of Labor Statistics. I don't think the new guy is in there. Was it Giannini? Do you know that guy's? I know he's a friend of Stephanie's, but I don't think he's actually in the position yet. So they got probably a stand-in, and whether he's afraid of getting his head lopped off and he's going to try to make those numbers look better, I don't know, but I think it could be, there's a potential it could be a real shocker on the downside tomorrow. But certainly we're seeing just a lot of evidence that perhaps there is a recession already underway, and it just hasn't been acknowledged. But really kind of the key thing, and I know you've talked a lot about the K-shaped recovery, the top of the K is doing well, bottom not so well. You even brought up maybe it's an I-shaped recovery with a small I at the top of those that are doing well. But there's just some data here that that's the case, that how really challenged a lot of lower income Americans are, and even kind of middle income Americans. And really, you're seeing more and more of this, how it's kind of working its way up the pyramid and starting to hit people who typically are more insulated from economic declines and contractions. But it is confusing. I mean, the Atlanta Fed is now 2.1% for this quarter, maybe even a little higher now. We have to keep bouncing these. This was, sorry, I thought we'd updated this. I think they're at 2.9, and now the St. Louis Fed is more like positive 1.7. So ironically, the Fed has actually been increasing with their estimates of how the economy is doing, not decreasing.
Which is interesting. Like you said, there are a lot of cross currents here. One thing just on the importance of the economy, right? I mean, sort of as goes the unemployment situation, so goes the economy. And I think that was what caused Powell to blink at Jackson Hole. He seemed to really focus on the jobs market as, hey, we were feeling pretty good about it, but actually all of a sudden that data started to deteriorate more than we thought. And we just got, I think it was yesterday, David, might have been, no, I think it was yesterday, where we got the data that's the new JOLTS data that said for the first time in, I don't know how long, but a long time, we now have more applicants than we have job openings. And really when the Fed
Yes.
started its hiking regime, it kept citing the disparity, meaning we just had way more openings than we had applicants that could fill it. And all of a sudden that narrative has now flipped.
Yes, you're right. It's I believe it was the highest job opening number since December of 2020. So in the wake of COVID. And the other thing that's changed here lately is that we're now seeing not only a drop in hirings, which has been going for quite a while, but now a bit of a surge in firings, because that had been kind of the bull case of our story for the bond market is, well, yeah, sure, employers are reluctant to hire right now, but they're not firing. Well, now they're starting to fire, and I think that's something really worth keeping an eye on.
So one question on that. So,
Mhm.
sorry, I'll shut up in just a second here, but I feel this is so important. So, historically, if you look at the unemployment rate, it after a recession it declines and then it stabilizes, and then when it bottoms out and starts increasing again, it tends to kind of, I mean, pretty much almost every time in the data series for the past 50 years, once the bottom is in and it starts increasing again, it generally then starts spiking up into what is retroactively later on declared the next recession. And usually that's coincident where the start of that recession is where the Fed is just starting to cut, and then the Fed is usually panic cutting as the unemployment rate continues to rise. This
I think
smells
those
a
are both
lot like
critical
that.
points, Adam. I'm really glad you said that. This actual next visual we have shows that spiking. It's for new entrants, so basically college grads. But you're right, and I've heard several people. I think the guy from Bloomberg, I forget his name, Simon White, maybe, but
Simon
he
White,
brought
yeah.
this up that once you do kind of, it's like our theory of trading ranges with stocks, and as I've said to you a number of times, we found it also works with macroeconomic data. When you're within a certain band or range for a number of years, and then you break that one way or the other, it tends to really keep going. So I think you're absolutely right about that. So it's a very good point to make. And I think from the standpoint of from a societal tranquility standpoint, this particular image that we're looking at here is not good. I mean, we've really never seen anything like this kind of spike for college grads. I guess it could even be for coming out of business school or in a graduate program. I'm not sure. It just says new entrants, but certainly supportive of what you said. And then this is just looking at the trend in non-farm payrolls, which had been down even before the July shocker. And I do think that part of the issue that, like Danielle would say is, look, this is not new. The Fed should not have been surprised because these revisions have been going on for a long time. And actually, I don't know if you've heard Darius Dale, who's on your show fairly frequently, and he tends to be relatively bullish on the economy, relatively bullish on financial markets. I just heard his most recent video. I was shocked at how guarded his outlook is for the economy, and he's really hammering on the jobs market, and virtually all the job creation over the last couple of years has been government related. And that basically the true private sector job growth has been paralyzed for a very long time, which is consistent with a lot of this data that we see that indicates that things have been softer than popularly believed. And maybe there were political reasons for that. I don't know. But what we do know for sure is that a real recession is way overdue. I think this is a new visual for you. You didn't have
That's a
this one.
great visual. Look at that.
Yeah. So this goes back 170 years and 34 recessions. And you can just see by the coloring that certainly it's fair to say recessions have become much less frequent. And you could say good job, Fed. But of course, what's come with that good job, Fed, is a lot of asset bubbles and a lot of inflation. And,
Yeah, a
the
lot
Fed,
of inflation, a lot of wealth inequality. And sorry,
a
not
lot
only
of
less
wealth.
frequent, but less long-lived too, it looks like.
Yes, and of course, you could say, well, COVID was really threw a knuckleball at everything because it was a flash crash, but it did kind of reset things in its own way. So it maybe, maybe this looking back and saying we haven't had a real recession since 2009 or so is a bit misleading. But regardless, it's been a very, I mean, going back to this beginning of the century millennium, it's we just haven't had much in the way of recessions in 25 years. and the one that happened at the beginning of the century was pretty mild. But anyway, we're overdue, and that doesn't mean it's got to happen. And we're going to talk about reasons why it might not happen, but it is something to be aware of. So I really
It
do want
is.
to talk about housing.
Sorry to interject with this, and maybe we'll get into more of this later on in part two. But I interviewed Greg Lukianoff about the coddling of the American mind. And his
Mhm.
point was, American society has just become less resilient because we have gotten more comfortable and we've become more sheltered and protected from adversity. Could you almost say the same thing about the economy, just because it just hasn't had to deal with the natural cadence of recessions?
I think absolutely. I believe that the Fed has become so hyper sensitive, maybe to their mandate on the, keeping unemployment low side, that they ignore the implications of these, what I call the Fed sometimes the big easy. Because really, if you look at most of their monetary policies, for this last 25 years, they have erred on the easing side repeatedly. And so you never really get kind of an extensive cleansing process that eliminates a lot of inefficient companies and basically allows for a debt pay down and maybe a more durable decline in inflation and just the kind of things that recessions serve a purpose. I mean, it's kind of like what Buffett said about capitalism, that capitalism without failures, without bankruptcies, is kind of like Christianity without hell. I mean, you've got to have some consequences for bad activity, bad decisions, and instead, I think what we've done is we've just continued to use cheap money, low interest rates, or overt money creation, which has been going on in different ways, even in the most recent years, as your friend Michael Howell says, the not QE QE. We can talk about that a little bit later, but yes, I think that's exactly right. And we're constantly trying to avoid pain. That's kind of what's become the American way, no pain. But remember the rest of that, no pain, no gain.
Right.
So yeah, I may have been a long-winded way of agreeing with you, but I really do want to talk about housing because I think this is another one that could be a big surprise. I don't think most people are aware. Certainly, most people that own home builder stocks are not aware because the home builder ETF is basically right at an all-time high, very close to it, just a little bit, and yet their business is terrible. And if we look at this, so starts and permits are both down about 20% year over year, and permits do lead. And as you can see, this is another thing where you go, wow, this is hat tip to Danielle once more, but this looks extremely recessionary. And this is the part that actually I really want to home in on because you've had two housing experts on recently, Ivy Zellman and Melody Wright. And Ivy, I think, just briefly touched on this. Melody Wright really drilled down in this idea that new homes are now at a discount to existing homes and how unusual this is. There was a period briefly in '05 where they kind of converged, and I think, really instantaneously the existing homes were a little bit cheap, new homes were a little bit cheaper. But now we have quite a yawning gap. And according to Melody, which I totally agree with, it's even more dramatic than what it looks like superficially. So basically, the official numbers are a median existing home is 435,000, a median new home is about 395,000. So a significant difference, a discount, which doesn't make any sense. But we'll explain why that's happening. But what Melody is saying, and this is what really resonates with me, is if you adjust for the discounts that the builders are giving, they're kind of like off the radar, such as buying down mortgages, free appliances,
Right.
other perks that they give new home buyers that existing home buyers are not able to offer. If you include that, the gap is about 80,000. So from 435 down to 355. That's just stunning. But I think what it tells us is that's really where the market is. The market, so existing homes probably should be, instead of at 435, more like 335, but they're
Mhm.
not. And that's why home sales are so terrible. So something's got to give. And we saw a little bit of this back in 2005, 6, 7, and eventually the prices did come down. And I guess my point is that I know that Ivy Zellman said she thought prices might fall less than 1% next year. I think that's way too optimistic. She's the expert, I'm not, but certainly I know Melody agrees. So,
Yeah, and I'll take the under on that as well. And as well, I think we talked about last time we recorded this. So I'll say it again. Is I think Ivy has the burden of having a lot of corporate clients that pay her firm a lot of money, and so I think it's just more challenging for her to be bearish and pessimistic. And I don't want to say that she's intentionally selling things rosier than she believes, but I think that it's a tough position to be in.
Certainly listening to her commentary, it was very disturbing. And, she really brought up the idea that the housing market's got this boomer problem. Guys like me, as you know, I've got a 70th birthday coming up in 2 months. And, I saw him right smack in the dab in the middle of the boomer cohort. And a lot of us are going to want to be unloading our homes. My brother's basically at the top. He's almost 80 years old. And, there's how many young people are out there that are going to be able to buy, especially these higher end homes where a lot of the baby boomers tend to be overweight. So I know I've got a couple that I'm going to need to get out from under. So
Yeah.
I
So
think
David,
it's
you
a
haven't
real
seen it
problem.
yet. So I'll just give a quick nod to it. But this morning, a few hours before we're recording this video, I released a video with Danielle Park, who is based in Canada, and she did a really deep dive into both the Canadian and the US housing markets. But Canada it's almost sort of like your chart back there of the higher unemployment rate amongst recent college grads. That's probably a preview of coming attractions to the general unemployment rate. Canada is in very many ways a preview of coming attractions for the US. And a main reason for that is, not only do they have an even bigger price bubble, but their mortgages are much shorter in duration than ours. About 5 years is average. So about 20% of the housing stock comes up for refinancing every year there. So they're entering this process at a much faster rate than we are. And it is clear that things there are softening at an accelerating rate.
Very good point. Yeah, and you bring up something that I think most Americans are unaware of, which is the housing bubble in Canada was even more severe than the United States. But for sure, when you look at this and you make this adjustment that Melody, and I think it's totally reasonable to, look at what the net, price being offered to new home buyers is, and it is, shockingly low, frankly, right now. But that just tells you that the builders have to acknowledge reality. And the reality is that a new home today is very unaffordable for almost everybody. So therefore, they have to cut the price to, clear the market. That's just the way economics are supposed to work. Kind of to your point, we don't like to take that kind of pain, and the threats to the lending community are obvious. So it's much easier to extend and pretend. But I think that time is running out, as it did back in 07 and 08. And this is one I remember you liked this one from before, but it's pretty amazing that when you look at the boomer generation, or I'm sorry, two cohorts of boomers, and then going back to even silent, if you put them all together, it's pretty close to 50% of home purchases are occurring among boomers. And, so almost half the market, which tells you how really kind of non-present the younger generations are with this. But I think that just speaks to what we're talking about. And where are we going to get these younger people to be able to afford, $1 million, $2 million homes when they can't afford $400,000 homes? I know not all boomers own, that kind of, but in the certainly the coastal markets and the major metropolitan areas, it's not uncommon to have $1 million home be just kind of a normal price. I'm sure you're well aware of that in Northern
Well
California.
aware of that, yeah, being California. So real quick, and I'm sure you're going to get here, but what's going to enable those younger generations to start buying again is going to be lower prices, even much more than lower rates. And we've had a lot of experts on to sort of explain why. And so the big question is, okay, well, what will get lower prices? And I think the answer is more inventory. And of course, we're already seeing this happen in a growing number of markets, Texas and Florida at the vanguard of that.
Well, thanks for the great lead into this slide. That's exactly what this slide is showing.
Great. And I just want to
Sales.
mention one last thing, and I'll let you run on this, but tying it back to what we were saying earlier. So what's going to create more inventory? Well, there's a lot of organic stuff that's starting to create it. But if we go into a recession where there's a lot of job loss, Dave, you would expect to see a lot of inventory come on from that basically people just can't afford the homes they have, especially if it's a second home or a short-term rental or whatever.
Absolutely. So this is, getting back to what I said earlier, that we found with macroeconomic data, when you see these big breakouts, they keep running. That's already happened with this. Hasn't yet happened with existing. It's pushing up, and I have no doubt it's going to break above this, going back basically 10 years. And so we're going to see a lot more existing inventory hitting, kind of consistent with what you just said. So I think that's absolutely right. Then if we look at the combination of the two, new and existing, clearly a pattern of higher highs, break out to a 5-year high, So just, my bullet here, which I put in, which we just were saying, is when it comes to prices, watch out below. So I'm the most bearish I've been on the housing market since 2007. And actually, I think, that's when I started writing my newsletter for the first time, was in '05. And my basic point in '05 wasn't that there was a bubble in housing. It was just that stocks were cheaper than housing, in my view, at that time. And then by '07, it had become a full-blown bubble with all the crazy financing. And so I was very, very worried about a housing meltdown back in 2007, 2008. As it turned out, I wasn't worried enough. It got way worse than I thought it would. I mean, as you know, it almost crashed everything. Okay, but so
Hey, sorry, let me just ask you a question before you move to bonds here. So one question I've been getting in recent days, I just love your thoughts on, is, hey, Dave, I understand all the reasons to be pessimistic on the housing market and certainly the home builders, right? Why did Berkshire Hathaway just, buy these stakes in some of the bigger home builders? Do you have an inkling why?
I don't. I do think that it was, the two younger guys that who are not all that young anymore that are controlling that pot of money. But it was, I think about $1 billion that he put in, that Berkshire put in. I don't think, again, it was the Oracle himself.
Right. So sort of a minor
Relative to
stake for a
340
balance sheet
billion
as
in
big.
cash. I mean, superficially, this is where, and these guys are super smart. I'm sure they do this kind of adjustment, but one of the biggest traps you can fall into as an investor is to buy low PE cyclical stocks when prices are high, stock prices are high. And usually that's when earnings are high too. It's a little bit different this time in that earnings have already been cracking for these builders, and yet the stock prices are, as I said, almost at their highs. But in a cyclical industry, and housing is notoriously cyclical, earnings fluctuate a lot. And what you typically want to do is you want to look at price to sales and get a sense, are they cheap on a price to sales or revenue basis? And they're not. They're actually quite expensive. So that kind of jives. And so maybe they're just, or maybe they just, they have a very long-term time horizon, and they may be saying, look, there's this chronic shortage of housing in America, which is true. There is a shortage of housing, but the word that keeps getting left out is affordable housing. And the problem is these builders don't make that kind of product for the most part. I'm sure there's some niche builders that do, but it's, most of these guys, they go where the margins are, and the margins are the more expensive homes, and those are the ones that are just not affordable. So I'm talking my book. I'll just admit it. I'm short a bunch of XHB, and I've had a kind of mixed success with it because it had a big breakout a couple of years ago, and I covered and kind of small loss, and then I shorted a bunch when it was up and covered, and now I'm shorting it again. But I know most of your people don't want to do that. If anybody's a put buyer, I would say you might want to look at puts. But anyway, housing, I'm bearish on, obviously, much more so than the stock market, where I think there's pockets of value, though not a lot. So global liquidity, this has been what's driven everything. And
All right. Hey, sorry to interrupt, but I think maybe I distracted you from talking about the previous slide.
the interest rates.
Yeah.
Sorry about that.
And it's important,
Thank
so I
you.
didn't want you to skip
Thank you
over
for
it.
pointing
Yeah.
that out, because this is important, not only in terms of its impact on housing. And what we know, of course, is that since the Fed started easing back last fall, long-term rates have actually gone up. And we've got this is the 10 years about a 4.25 today, which has come down a little bit. The 30 year is being very stubborn, up right around 5%. It's down in yield a little bit right now. But if you look at other countries, other developed countries, what you're seeing is a disturbing situation where even though industrial production is falling, interest rates on the long end, not the short end, but on the long end, are rising. And that is, if you listen to somebody like Luke Groman, he's saying that's a classic emerging market in trouble kind of scenario. So I keep a very close eye on it. It's not as bad in the US, but it is still even a little concerning in the US. And it's going to be tough, unless people are really going to go with variable rate mortgages to stimulate the housing market with lower interest rates by the Fed if the long end is going the other direction. And again, the key point is, since the Fed started cutting last year, long yields are up. Very, very unusual. But it's not in emerging markets, at least those that have been in trouble or under stress. Thank you for getting me back to that. But let's talk about liquidity, because this has been why the markets have been so frothy, and why risk assets, I mean, whether it's crypto or meme stocks or 0 days expiration options, you just go on. Credit spreads, junky bond credit spreads are super tight. So it's just indicative that there is way too much liquidity out there. It is, you look at the global money supply, it's growing faster than the US. Maybe that's why overseas markets have actually been outperforming the S&P this year, which a lot of people don't seem to be aware of, but it's a fact. So maybe that global liquidity has been doing overseas what it's done in the US for so long, but now that's actually slowing. And according to Darius, he's got it going from 11 to 15% earlier in the year to 4%. So that's really a dramatic slowdown, which maybe fits in with why he's kind of changed his tune. I think what he believes is that the Fed and the Treasury are going to shift gears here, become much more stimulative soon. So don't get too bearish on stocks or Bitcoin or gold. But this whole idea, I mean, I hear this all the time. There's this mountain of money on the side of cash on the sidelines, but it just doesn't show up. This isn't a B of A. There are trillions of dollars that they hold for clients, so it's a good sample set. And I saw a similar graph, I don't have it here, but on cash levels among fund managers being very low, which makes sense. I mean, there's been a lot of pressure on anybody running money to be fully invested. And of course, so much of the market is driven by index funds, which by definition are 100% invested all the time. So I don't get it. But in terms of positive global liquidity, as Michael Howell pointed out, China's already created about 1.5 trillion of stimulus, and he thinks another amount is coming similar to that real soon. And that, I think, for your viewers, is a really important fact to latch onto because it is highly supportive of natural resources, some of which have done extremely well already, a lot of which are still lagging and have quite a bit of upside, particularly in energy. So, we'll talk about this in the second part with Michael Howell and his liquidity views, but he is, I think you believe like I do that he's one of the world's foremost experts on liquidity, and he's got some semi-encouraging comments there, although with a footnote or caveat. So here's been this big fiscal stim, and our mutual friend Kevin Muir's been all over this. These budget deficits that have been running 2 trillion, and that is really stimulative, and it's just been going on for years and years and years. So we're all kind of used to it. But Doge unfortunately struck out, and we've got in the first 10 months of this year, the deficit was actually up about 7.4%. We're headed to about 1.2 trillion expenditures just on interest. We're about 1 trillion now, but the trend is up as the debt rolls over at higher rates. So it's still that federal fiscal funding fiasco is still a fiasco. Now this is excuse me, where the Bitcoin stablecoin comes in, because I really have had an epiphany. Kudos to Luke Gromen in this regard, that stablecoins are really a big part of the solution the government's going to employ. And so they want, as Besson has said, we want 2.7 trillion to go into stablecoins. And where that relates to Bitcoin is that almost all Bitcoin purchases and sales occur through stablecoins. And his point is there's a multiplier effect, and when I say his, Luke Gromen's point. So if there is a decline, even if there is a decline in the velocity, if you will, so how much stablecoin translates to Bitcoin activity, it's been a pretty high ratio, and I forget exactly, like 10 to 1, and he's using something like 6 or 7 to 1. But his point is, if that kind of money goes into stablecoin, it's going to put a lot of juice under the Bitcoin rally for its next move. But I think it's a good question to ask, where's that money going to come from? And I've been, trying to roll that around my mind. I know the U.S. banks are worried it's going to come out of deposits. So if investors shift and say they take, just could be simple, 2.7 out of the banking system, they put it in stable coins, that's not great for the banking system. But what's probably more likely, and this again is an acknowledgement of Luke Gromen, is that it would come out of the Eurodollar market. And I know there's people you've had on that are big adherents that the Eurodollar market is what really matters. And I don't know, it's always been kind of a mystery to me, but apparently there is $11 trillion, which sounds about right, in the Eurodollar market, which is really uninsured. It's not really protected by the U.S. umbrella of the Fed and FDIC and so forth. And so if there is this desire to get that money into stablecoins, but without hurting the U.S. banking system, I think that's a very logical, point of funding that we're going to see here coming up pretty soon. And I think a good point to consider, maybe you've had some experts on that comment on this, is what would happen if the Eurodollar market comes under a lot of stress. And it has at time, typically during a crisis, there has been weakness, and then the Fed does their dollar facilities, dollar lending facilities. But have you heard anything about that Eurodollar market and what could go wrong?
I have not. So literally, as you're talking here, I'm making a note to reach out to Brent Johnson, Dollar Milkshake Theory developer. Brent talks probably, maybe with the exception of Jeff Snyder, talks the most about the euro dollar market. And I'm going to ask him today his thoughts on this.
Great, thank you. I'd love to hear it. You mentioned Jeff Snyder. That's the person I've listened to who's gone into great detail about the euro dollar market. So thank you. It's just, I think, something people really should be keeping an eye on because it's clear the government has a tremendous fiscal financing problem, and this could be one of the big solutions. I'm not saying it's going to be the panacea, but it's definitely something they desperately need when you look at these next few visuals we come up with. And it wasn't that
Right.
long ago we
Dave, I sort of see the government kind of like, pulling from everywhere it can here, right? So, okay, let's get a couple trillion from stable coins. Let's try to work on, continuing to Doge, even though that doesn't seem like it's doing all that much. Let's, obviously try to get the 10-year yield down. Like it's going to be a multifactorial approach to this. Let me ask you this, and you don't have to answer right now if you want to wait, if you've got slides that talk about it. But, Besant has been saying, hey, the tariff revenue is starting to become pretty material. And I know you showed the slide showing that July's deficit was big after a dip in June. But Besant's now beginning to say like, hey, it's been kind of coming in around 300 billion. I think we're on track to 500 billion pretty soon. And to be honest, I'm thinking we might be close to a trillion next year. Now, obviously, he's paid to be optimistic here. But let me just ask you this. Let's assume for a moment that he's correct and tariffs keep mounting like that, tariff revenue keeps mounting like that. And let's assume, for whatever reason, efforts on behalf of the administration or just a recession and there's a safety trade and a bunch of money runs into treasuries and yields come down. Will that make a material help in getting this side under control? And I guess when I say recession, I got to be open to the fact that if we're in a recession, at some point the fiscal spending is going to go bananas, so it might offset all that anyways. But what are
Yes,
your
I'm glad you brought that up because that's what I was going to say. That's the problem that you've got with this. Okay, buy bonds, buy long bonds because of recession. And that's why I was bringing up what I did earlier that I think is so disconcerting is to see, this industrial production as being a reflection of economic softness. And that when you have that and you have rising long-term bond yields like you do in France and the UK and even in Germany to a degree, Japan, although Japan's economy is a little more vibrant, that's a definite warning sign that the normal, buy bonds in a recession game plan isn't working. So what you're describing though is kind of a push me pull you type of situation where there be positives from the stablecoin effort and the tariff revenues versus the the hemorrhaging that occurs when you go into recession with all the entitlement payments that go ballistic. So it's going to be, I mean, I said this, I was on a podcast yesterday with one of your esteemed peers, and I said, look, anybody that tells you they know what's going to happen, I mean, they're guessing. We're always guessing. And it's like Yogi Berra said, it's always hard to make predictions, especially about the future. But right now, I mean, we've never had this tariff situation, at least not in, but basically 100 years. We've never had these types of deficits during good times, supposedly good times. Certainly, the economy officially has been in expansion mode for years and years and years. So it's very hard to know what's going to happen. And that's, I guess, kind of well, so what does that mean? I think you want to do a Buffett. I mean, he's got 340 billion in cash and, just kind of adjust it, size it to your portfolio and, just 4% probably headed to 2% on short-term rates, but you're not going to lose money. And well, that was more of a digression than I probably should have done, but it's a good lead into commodities, which is another kind of a key part of this presentation. And it has been a bit frustrating to me, I will admit, in that we have put out a series in our newsletter of very good recommendations on commodities, even on oil, but especially on gold. We flagged that breakout that happened early last year. I mean, that was really impressive on a chart and stuck my neck out and said, I think this one's going to keep going. Then we did the same thing earlier this year on silver. And, there's been no thank you note showing up in the mail or even in the digital mail. But I think silver's off to the races. I know you've had some people on that have been bullish on silver, and I think some of these silver miners My personal preference is First Majestic, but there's others out there that are, or you can just buy the silver mining ETF. It's always safer to do that. But it's pretty amazing when you see some of these return numbers. But here's the chart on silver that we showed, and again, broke out over critical resistance, and it's just off to the races. But I will say this, and this is
That chart hasn't been
my big,
updated since we had our failed attempt a couple days ago, right?
well, it broke when it broke out over 40. I don't
Because
think it
yeah, I
went.
mean, no, I think that's the spot price you're looking at there. But I know that silver futures yesterday were over 42 at one point.
Yep, it's clearly run a little bit more from here. But it's just as a pattern that happens so often when you see these resistance taken out, and we like to be at least 3 years. 2 years is pretty good. 3 years is usually our minimum. The longer, the better. The longer something's been in a trading range, the longer it's been basing. So the bigger the base, usually the bigger the breakout. And I'm amazed how many people will only pay lip service to that. They don't really hunt for investments to profit from it, but we do. This is from my friend Fred Hickey, who I think, have you had him on your show yet?
I have, yeah, several
Yeah,
times.
he is one of the best. He's made us a lot of money in the gold mining area. I have to, and his newsletter is so reasonable. I guess newsletter writers aren't supposed to endorse other newsletter writers, but I will
Well,
vehemently.
his is great, and his has been a standard for a long time. And for folks that aren't familiar with it, it's the high tech strategist, and Fred's been writing about the high tech industry since the '80s. But he is one of the biggest, endorsers of gold out there, and it's so funny to see, a high tech guy being such a gold bug.
Very true. And what he's pretty good at too is he's willing to take profits. I mean, he's definitely not a perma bull in the precious metal space. In fact, he ran this page one of his newsletter that just came out. So this is basically telling you that the gold miners bullish percentage index is at a level where it's rarely been. And the two prior times it was here, the miners got smacked. So I do believe this, and we have been huge endorsers of the miners. I mean, it was the quantity of investment advisors, even newsletter writers that were endorsing the miners a year ago when gold was running and they weren't. You put them on one hand. It was talk about feeling like the Lone Ranger. But
Hmm.
he just kept pounding the table and saying, "Look, these earnings are going to take off." And Fred gets more credit for that than I do. So it's I think I've got that coming up, but I'll just in case I don't, or it's in the second section. It's how many people, Adam, realize that the gold miner ETFs, GDX and GDXJ. So GDX is the senior, GDXJ is the junior. How many people know they're up 95% this year? I would guess hardly anybody realizes that. And
So, all right,
a little
I know you want
frustration.
I know you want to talk about other things, and I'll let you hear in a second. But this is a great question. So those of us that have been following gold for a long time, we all remember when Grant Williams famously put out about 10 years ago his gold report that was titled "Nobody
Nobody
Cares."
cares.
Right. And he said, look, there are all these great reasons to own it that are probably very valid, but it doesn't matter right now because nobody cares. Now, since then, in the past couple of years, we've had the central banks wake up and they've started caring, and that's been a big reason why the metals have moved. We've also had the Eastern investor care about gold, wake up and care about gold, but the Western investor really hasn't showed up to the party. And I guess my question for you, Dave, is, you know, Wall Street hasn't liked gold for a whole bunch of reasons, and this is a small sector and all that type of stuff. But at the end of the day, Wall Street likes making money and it likes momentum. When will Wall Street start waking up to what you just mentioned?
Probably at the wrong time. Probably when it's time to take some profits. And that's what I would suggest, though, with a big footnote here on this. And I guess if we want to, I mean, gold is important enough, probably it's worth the diversion. But uh, first of all, to your point about how do you avoid, because you're kind of saying it's really easy to be too early. It could have a great story, and yet you sit there for years and years with it just going sideways. So one way you can avoid that is wait for a breakout. Now, typically, you're not going to get the bottom. And I'm totally sympathetic to the idea that when something's really, really beaten down, and it's got a great fundamental setup, sure, buy some. But when you really want to be aggressive, it's probably when it's been in that range and it breaks above it. If you missed all those years of sitting around, you bought it at a little over 2000 last year, what are you up? 75%?
Yeah, you
And
had a great ride with a lot less risk. Yeah.
and the same thing with the miners. We'll look at some of these charts coming up on that. Uh, Most of these commodities that I've got shown here have had these basing patterns. Some have broken out, some haven't. Oil is, of course, the real redheaded stepchild right now. But it wasn't long ago that platinum was in that same boat. It was just the
Yep.
spring that we were telling people at $1,000 when gold was 3,300. You remember platinum used to trade at a premium to gold for years.
Hmm.
But, platinum credit card is better than a gold card, right? So we thought it was a steal, but it's up 36%, still probably going to go. The supply, a lot of these commodities have a supply deficit, and the demand just continues to grow. And I think at some point that's going to happen with oil. I know Rick Rule, you've had him on. He believes the same thing with oil. There's been
Yep.
such capital spending starvation in that industry. Palladium is one where it's breaking out, and the fundamentals are much better. You get these narratives that people hang on to, and they'll say, well, I don't like palladium because of EVs, because EVs use very little of any palladium. What they miss is that hybrids actually use more palladium than do internal combustion engines. And hybrids, I mean, the EV story is really tired. The hybrid story is very exciting. So when you get these kind of misperceptions is when you can really make some money. So, and then if you get down to the bottom, natural gas, it's not as behind the moon as oil is, but it's in the twos, and that's very cheap on a global basis. And then you look at what's happening to electricity demand, it's just going through the roof. And this is what the data center is just starting to kick in. So like you had Stephanie on your show the other day or 2 weeks ago, and she said, if you love AI, you should really love energy. Well, people don't, as we're going to see here coming up. Anything before I move on to the stock market? I'm just going to go through stocks really quickly, but
No, I'm biting my lip on a lot of these things just because we could take almost any of these points and speak for another hour on them. So I want to let you, make the progress you need to make here.
well, we better talk about the stock market anyway. We always have to cover that. And Jesse Felder is one of my really good friends, and he writes some great stuff. And he had these, this is looking at the equity market valuation using a composite. So not just the Buffett, not just the Shiller PE, but, like a mosaic of these guys or these factors, and you can see how expensive it is. And you look at the momentum, and this is, I think it is a two-tier market, and I am very hopeful. People say, "Oh, you're too bearish." Well, I'm bearish on stuff like this, these crazily overpriced stocks, which frankly I called out in my book Bubble 3.0 that went out in early 2022, and they went down 70-80% in 22 and into 23. So they got shellacked, and some of them will rally back, some haven't. But you just can't look at something like that and not say this is a bubble in this part of the market.
It just
So
looks insane. Yeah.
what I'm personally hoping for, and as John Malden often says, hope isn't a strategy, but I do think we can see a rotation away from, some of these high momentum, extremely highly valued companies where sometimes we're trading at 30 times sales, forget earnings, and into these companies I think you could throw a dart at the energy sector and make really good money over the next few years. I can't believe how many cheap energy stocks there are out there. Petrobras is one of our favorites, and double-digit yield, selling about 3 times earnings, and they do have some of the best reserves in the world. Okay, so then this is what I was saying earlier. I think you could, along with the miners, win a lot of money. Oh, this is Sharpe ratio. This was supposed to be switched out, but even when using Sharpe ratio, which is risk-adjusted return, these foreign markets have dramatically outperformed. One of my favorites, as you've heard me say, is Brazil. Brazil is up about 33% this year, and that's in dollars. So this is in dollars, not local currency. The dollar's weak this year. So for once, it's actually these returns are higher in dollars than local currencies. But my point is there's a wind shift going on, which I think is supportive of what some people call the great rotation, like we had in 2000 to 2002, where the tech bubble popped and the money went into more value-oriented securities or sectors. Positive, certainly earnings have been much stronger than I thought, or even the street. Second quarter earnings come in at about plus 13%. Now, there's a lot of pretty generous accounting that goes with that, but let's just say that's what the official numbers are indicating. But here's energy.
How much of that is the Mag 7, power hyperscalers, driving the average higher?
Well, I don't think there's any question that's been a big factor. There's also cost cutting. That's article in Wall Street Journal today about how cost cutting has been flattering earnings, and what's one of the biggest line items companies have, and that's labor. And I think that as things get tougher on the top line, which I think they probably will, then they'll be more inclined to cut their workforce, which is, we've already talked about, that's starting to happen. But you're right. I mean, that's a positive, is that that's why you can have a company like NVIDIA selling at a $4.5 trillion market cap, which is way more than most stock. In fact, I don't think there's any stock market in the world. Maybe China has a market cap that big, but most of the other leading, entire markets are less than 4.5 trillion. But it's because profits have been so strong out of that group, with the exception of Tesla, which used to be part of it. But yes, good point. But here, if we look at energy sector fund flow, so what this is again from Jesse. His point is if you go back to the pandemic, so the last 5 years, the XOP, which is the oil and gas production ETF, has actually dramatically outperformed the market, and yet look at what's happened in terms of flows. So investors just keep taking money out of this sector. We can talk about why, but a lot of it is due to misinformation from the leading energy authority, the International Energy Agency, which has just been so wrong for so long. But I mean, look at this. I mean, this really tells you the story, all you need to know about why you should be buying energy if you're going to think about an extended time frame. The end of 2007 was 13% of the S&P. It's now 3%. And yet we need energy more now than we ever did, especially with what's going on with the whole AI revolution.
Yep.
Because it is an energy hog. So I just think that's where you should be putting it. You should be overweighting that area. Instead of being at 3%, you should be at 6, maybe even 9%. A lot more exposure makes sense to me than it does apparently to everybody else, almost everybody else. I know Stephanie would agree, and Rick Rule. Small caps has been another area experiencing outflows, and they've been underperforming for a long time. I actually personally prefer the mid caps, and they're starting to break out. Actually, pretty impressive breakout, though it hasn't done much since breaking out. So that's the section on kind of my thoughts, and so we've got some time. We got through that pretty well, so we have some time to talk about part 2. But anything we should cover here before I move on?
No, except just to thank you for putting all the work into this, folks. And folks, so this is the type of monthly, sort of macro and market recap that Dave and I envisioned him providing the Thoughtful Money audience here on a monthly basis. If you have enjoyed this and would indeed like to see this continue, please let us know in the comments section below or in the live chat if you're watching the premiere on this. If the feedback is as positive as I expect it's going to be, David, we'll do this as often as you guys want us to continue it, and for as long as Dave's got the stamina and the interest to do it. Even though he's in quasi-retirement, he's a busy guy, but it's a huge privilege and benefit for us here at Thoughtful Money. And Dave, if folks like this as much as I suspect they will, there'll be a lot of pull to keep this going monthly for, again, as long as you want to do it.
That would be great, Adam. I hope so.
All right. Well, now let's get ready to trundle over to part 2 here. Just a couple quick things. One, Dave mentioned that Lynn Alden did just join the faculty for the upcoming Thoughtful Money Fall Conference. If you haven't yet bought your ticket for it yet, do so now while it's still offered at the early bird price discount, which is the lowest discount that we're offering. So to go sign up for that, go to thoughtfulmoney.com/conference. And if you are a premium member to our Substack, make sure you check the emails I've sent you that have the discount code in it, where you can get an additional $50 off of that low early bird price discount. Also, if you are a premium subscriber to our Substack, don't worry about finding part 2. It's going to get emailed to you the day this video releases. But if you're not a premium Substack member, but you're interested in becoming a member of our YouTube channel, this new program that I just mentioned, it's only, I think, $5, or I think more specifically $4.99 a month to subscribe to it, and you will get, amongst other benefits, the monthly kind of retroactive on all the key takeaways that we took from a lot of the top experts that came on the channel in the past month. Dave and I are about to go record that right now. If you are not yet a member but would like to become one, I believe the way you do it is you subscribe to this channel, which is free, so you click the subscribe button. Once you've done that, if you click that subscribe button again, I think it then brings up the opportunity to become a member. So hopefully you see it in the set of menus there below the screen here. And for those of you who have become members or who are existing premium subscribers to our Substack, we'll see you over in part 2. Dave, thanks again.
Thank you, Adam.
All right.
Chat soon, real soon.
All right. And we'll see you all in part 2, and everybody else, thanks so much for watching.
At the end of this, it's going to be a silver standard, not necessarily a gold standard. Going back to gold would be better where we are now. But the real end of the inflationary system is when credit is going to collapse. When credit collapses, dollars don't work. And if dollars don't work, none of the other currencies work either, because that's what we say reserve currency, right? That's currency that's in the basement of all these other central banks. So when the dollar falls, or these other currency falls, all credit falls, all credit derivatives, and then you're left with all the purchasing power of all that lost purchasing power gets vacuumed into silver, even more than gold, which is why we're going to go eventually to very near a 15-to-1 ratio, which is the historic exchange ratio, monetary exchange ratio between gold and silver. That's natural economic law.
Analysts note that in a crisis, gold and silver could surge, with the gold-to-silver ratio potentially falling from 90-95 to 1 back toward its historic 15-to-1. Silver's dual monetary and industrial uses, combined with its affordability, may spark strong demand from ordinary people. While fiat collapse isn't directly emphasized, stress from dollar weakness and debt issues could still drive a rush into physical silver. Rafi Farber, also known as the end-game investor, is a financial writer and precious metals analyst. Silver played a central role in global trade for centuries, particularly in China, where taxes were often paid in silver, thereby tying the economy to the metal. This dominance shifted after the U.S. Coinage Act of 1873, known as the Crime of 73, which demonetized silver, hurting miners, farmers, and debtors while favoring the wealthy who held gold. Attempts to restore silver through the Bland-Allison Act, 1878, and Sherman Silver Purchase Act, 1890, were short-lived, and the system remained gold-centric. Recent scholarship also highlights how silver's volatility, particularly in Ming China, fueled both trade growth and inequality, concentrating wealth among elites at the expense of ordinary people. Rafi argues that societies built on financial theft eventually face a reckoning, just as debts must eventually be settled. In the endgame, silver will likely return to a stable 15-to-1 ratio with gold, forming the base for rebuilding a more honest economic system. Gold and silver are regaining importance in global trade as nations transition toward a hybrid system that blends traditional money with digital tools. Despite slower global growth, metals are forecast to rise over 30%, driven by fiscal pressures and safe haven demand. Analysts also suggest silver could outperform gold due to the historically high gold-to-silver ratio. Before we examine the video, please click the bell symbol and subscribe to receive updates on our latest uploads. We always value your thoughts and feedback.
A lot of people say, and I think they're correct, that we've been talking about the pyramid, right? And gold is at the bottom. But underneath the gold is an even smaller triangle of silver in terms of value. Look, before gold was money, we talk about gold standard and going back to gold standard, and this is what we have to do. But really, it's not exactly that. It's really going back to silver is what we need to do, or what will be done. I understand that, trading silver coins is not economical in the sense that it's very bulky, and you can't actually exactly do that in today's world. But the human civilization started not on gold, but when we really started global trade and continents started trading in the Silk Road, and Africa started trading with Asia, and you really got a big economic system going, it was based on silver. And what happened in 1873, right, with the crime against silver, or what exactly they call it? I think it was the crime against silver. What happened was, who owned silver back then? It was the poor and the middle class. That's what they used for their money. What did rich people do? How did they store their wealth? They stored it in gold because they had too much silver. They couldn't store it all. And so they had a lot of gold. So what's the best way, if the middle class and the poor, and there's a lot more middle class and poor than there are rich, what's the best way to take purchasing power from the middle class and the poor and give it to the rich? If you're on a silver standard, move to a gold standard, right? That's how you do it. But everything that the government does in order to keep the pyramid going is basically a theft of the middle class and the poor for the favor of the rich. We have to go through a reckoning. That's natural law. Like, just as all debts are paid either by paying the debt or defaulting, all theft is paid too. Because when you steal, that value, when you make an exchange of two people and they're both benefiting, legitimate, when you steal, one loses at the expense of the other. And so you have a net negative effect on society. So when you have a society that operates through these sorts of theft systems, those thefts and those debts are going to be paid one way or another. Now, I have no dollar figure for where silver is going to go in the end game, but I do believe strongly that the end game bell. How do we know when this is all over? Like, the bell's ringing. Okay, well, the dollar has collapsed. It's going to be at a 15-to-1 gold to silver ratio, one that's relatively stable. I'm not saying like we hit it one day, like in 1980 it happened for a day and a half or something. I'm saying this time it's going to stay that way until we can rebuild a basic economic system again. So it could be a year or two, three. I don't know, but I'm saying it's going to be stable enough that silver supplies can filter through the economic system, physical silver supplies, and that figuratively almost literally creates a base of wider silver dispersal where you can rebuild another credit pyramid, hopefully an honest one where all debts are paid and you don't have fractional reserve or however you think the banking system functions. Well, what does the United States look like? I really don't know, which is why, frankly, I don't want to live here. I don't know what Israel's going to look like either. I'd rather be with my people than being here, precisely because I don't know. I would imagine that states could break off from the federal government. The federal government could dissipate, and you could have regions, different regions. Like, if the South had won the Civil War, you'd have the Confederate States and the Northern United States. So, might break into a few pieces. I think there's going to be serious trouble in the very big cities like in LA, New York, Chicago, Minneapolis, where you're from. These places that are morally rotting, they're not going to do very well. But I think outside of that, you will have Americans, and America will exist. The United States as it exists now, I don't know. I can't say yes. I can't say no. It might reorganize into some looser government or Articles of Confederation or something, or California, New York could cede and then leave the more fiscally responsible states into some other union. It could be anything. I just hope that we get through it with the minimal amount of suffering.
Rafi relates that the rise in prices we see today is only an illusion created by the inflationary system. When measured in real money, gold and silver prices have actually been falling for decades. If someone consistently saved part of their income in gold or silver, over time, they would need less of it to maintain or even improve their standard of living. The point isn't to stack metals to cash them out for more dollars later, but to step outside the illusion of the dollar system as much as possible. These metal-focused trends reinforce the notion that the current system creates an illusion of rising prices when measured in dollars. At the same time, real value units, such as silver, offer an accurate preservation of purchasing power. Rafi points out that the de-dollarization movement and individuals turning to gold and silver echo your point about trying to live beyond the constraints of the fiat system. Analysts predicting outsized gains in silver align with the idea that steady savings in metals could result in maintaining or improving one's standard of living over time, even as the dollar erodes. Now, let's recall the interview.
It's not that prices are rising. They only seem to rise within the inflationary system, within this illusory system that we're all stuck in, like a prisoner's dilemma, and we're all stuck in it. Prices are actually, they've been going down since 1960s. I mean, if you look at everything priced in money
And gold.
Money, I mean gold and silver, mostly gold, silver secondarily. But if you look at actual prices, they're going down. And so the prices are only going up if you insist on maintaining your economic existence within the illusion itself. And you could say, okay, fine. So let's say I want to get out of the illusion and just, take all of my salary and just buy gold with it every month. Well, I understand you can't do that because you need to be liquid, and gold is not as liquid as dollars. It would be if we were on a gold standard, but it's not. So then you could say, So then, we are losing out. But it's not just that prices have been staying stable in gold. They've been falling in almost every category. And anything priced in gold is going down. So even if your dollar salary is less, right, then the amount of gold would keep going down with however much you could put away every month. Let's say you earn like $5,000 a month, and you put, $1,000 a month away or $500 a month away in gold and silver over 20 years, and each month it's less and less gold and silver because they keep going up. But you need less and less gold and silver to even have higher standards of living. So you can live outside of this illusion. That's what I'm trying to get people to understand. It's not about stacking and then becoming rich and then using gold and silver to accumulate dollars. We're getting out of the illusion as much as we can. It's like like a drug addict, right? If you're talking to a drug addict, you have to understand how they think, but you can't go completely into their world. But you care for them, so you need to communicate with them in a way that they think that you're on their planet. But you have to. It's a very difficult position where we are, because we have to put a leg in the illusion and we have to keep a leg out of it and keep our minds together, which is it's very difficult even for people like us. It's all the more difficult for people who don't understand intuitively with the confidence that gold is actually money, and it still is today. That was the final piece that fell into place for me. That only I think in 2022 or something like that, when I finally understood, when it finally slipped into place that everything is really based on gold and silver in this entire pyramid that we're living on. The higher we get on it, the thinner the air gets, and the more insane we become keeping one leg in it while trying to keep one leg out. But
Rafi Farber's insights highlight silver's historic and future role as a form of real money, capable of preserving purchasing power and providing stability when fiat systems fail. With de-dollarization underway and precious metals gaining ground in trade and investment, silver's potential resurgence to its natural balance with gold reflects both a historical truth and a practical strategy for navigating today's uncertain financial landscape. If silver does return to a 15-to-1 ratio with gold, what impact would that have on global wealth distribution? How can individuals today best position themselves to step outside the illusion of the fiat system while still meeting everyday liquidity needs? We'd love to hear your thoughts, so feel free to share them in the comments section below. If you enjoyed this content, don't forget to hit the like button and subscribe to stay updated with future posts. Thanks for being part of the journey.
It means that the government has to start building stockpiles. And so it's another buyer, and it's a big buyer. This is a really big, big buyer. But again, this will also, who else uses silver? Companies like Tesla are going to have to start stockpiling now because they will know that there are higher prices in the future. Well, anybody that uses a lot of silver in production of goods needs to take a position now and protect themselves from triple-digit silver and gain that same leverage over their competitors. This has the greatest gains in absolute purchasing power. And that is what matters, is value, not price. And so we're looking at the price. It's up $1,000 this year. But is anything else up 48% this year? Not real estate, not stocks, not Bitcoin, nothing.
Since the government must now build silver reserves, it becomes a major new buyer in the market. At the same time, companies like Tesla, which rely heavily on silver, will likely start stockpiling as well, anticipating higher prices ahead. Any business that uses significant amounts of silver should secure supplies now to shield themselves from triple-digit prices and gain a strong edge over competitors. Mike Maloney is a renowned precious metals expert, educator, and founder of goldsilver.com. He explains that governments always find ways to tax people, either directly or through inflation. History, like Weimar hyperinflation, shows how war spending and money printing quietly destroy wealth until it's too late. As people save in fear, devaluation builds, only to erupt in sudden inflation when money flows back. Gold-backed systems once restrained this, but fiat currencies lost all discipline. Today, massive money creation and QE enrich the elite while draining ordinary savers. Gold remains undervalued, but the system will eventually face a reset. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
True, but the problem with government is they will just tax us more. Silver could go to $1 million an ounce, and they're just going to take as much as they can from the population in two methods: the regular tax and inflation tax. And as they print for war, I did a lot. When I was writing my first book, my study on the Weimar hyperinflation was a stack of books about a foot high. And so I had assistants. I didn't read all of them. I'm dyslexic. They read them and they highlighted stuff for me to look at. But we did a very intense study on the Weimar hyperinflation during that World War I. When there's war on your soil, you have a lot of anxiety, and every dollar you earn gets saved. So none of it is in circulation, and it allows the government to keep on printing and printing and printing, and you don't see the dilution of the currency supply. You don't see the devaluation of the currency until the war ends and the anxiety is lifted. And the minute some of that currency comes out of hiding, back then you would stick it under your mattress, not put it in the bank. But once it comes out from under the mattress, look out, you're in for a hyperinflation. And so, yes, it'll make war more expensive. But if we are having war, the population will start doing more saving, velocity will slow down. And the result is that the government can very secretly steal a majority of your wealth without you knowing it until it's too late. And that's what using gold used to do. And then we went from 100% reserve ratio. First we had gold. Then we had gold notes 100% backed. And then we introduced the Federal Reserve, and it was 40% backed. And then the Bretton Woods, and it dropped eventually to 8%, but there was no specified reserve ratio. But gold standards opened the door for this scam to all happen again. And so I hope we don't end up, I can tell by what countries are doing around the world that we are headed towards some sort of monetary system that has gold connected to it. Is it going to be another gold standard, or will the citizens of planet Earth wake up and say, no, we're going to use something real and that stores value? And fiat currencies have proven that they don't store value, and mathematically they can't.
Mike Maloney highlights that when manipulation breaks, the free market always wins, whether under fiat, digital currencies, or any system. True wealth isn't measured in unstable prices but in value relative to real goods like gold, oil, or wheat. Fiat money and floating exchange rates distort prosperity, stealing lifetimes of potential growth. History, like Weimar Germany, shows how loss of confidence leads to hyperinflation, where people rush to trade currency for anything tangible. In such times, gold rises faster than everything else, gaining real purchasing power. Today, with gold up nearly 50% this year, outpacing real estate, stocks, and even Bitcoin, it's clear that value, not price, is what matters. Now, let's get back to the interview.
Yeah, and that explosive phase change is when the free market overwhelms the manipulation, and it always has and it always will. It doesn't matter if we're in some digital currency system. It doesn't matter if they lock us in a jail cell and put us to work and extract wealth from us that way. It doesn't matter even if it's the matrix. The free market will overwhelm it. You and I spent a lot of time creating a chapter for the great gold and silver rush of the 21st century. And it's something that I dubbed wealth cycles back in 2010, I think. We measured like everything that we could measure where we could get data that goes back into the 1800s. And what we discovered there, what's going to happen? Yes, the old measurements, if you're using currency. Ratios? No. It's impossible for the ratios not to stop working. Once you use ratios, you are getting rid of the currency. That's being taken out of the equation. When you measure your house value of your home in barrels of oil, ounces of gold, bushels of wheat, tons of iron, pounds of copper, shares of the Dow, when you do that, you start seeing what true value is, not price. We have to stop measuring things in price and start measuring the value of things. Steve Forbes, there was a great animation that our animator Aiden did for Steve Forbes when he was in Hidden Secrets of Money. And he talks about, what if the foot changed every day? So 11 inches one day and 14 inches the next or whatever. Or if you're trying to bake a cake and the clock change, a minute is 40 seconds one day and 90 seconds the next day, things become impossible. Well, that is the US dollar. And all these floating exchange rates severely limit our prosperity and has stolen part of our lifetimes. You can absolutely prove that when you create greater prosperity, a population will live longer and be happier. This is just fact. And so, and you cannot go back in time and repair transactions that didn't happen or prosperity that didn't happen. And so these fiat currencies, these floating exchange rates, have shortened your lifetime and my lifetime. They absolutely have. And this is something that is provable. I had you insert a chart after this of the Weimar hyperinflation, simply because this looks like the Weimar hyperinflation. Yeah. Now, if you look at that early part from the end of World War I up until the beginning of 2020, if you make a chart of just that, it's a pre-hyperinflation hyperinflation. I remember we were interviewing Jim Rickards, and I was telling him I had discovered this pre-hyperinflation and I was all excited about it. And he goes, "I didn't know I was here for a history lesson." So anyway, that first phase was a conditioning that happened to the population. That loss of 90% of their purchasing power, this is a 90% loss in purchasing power, taught them that if they hold on to currency too long, so the second time that they saw this happening, that's when they started buying anything. A case of doorknobs will hold its purchasing power better than the currency. And so that's what caused that change in public perception and the introduction of fear of holding on to the currency for more than a few seconds caused that endgame hyperinflation. But the point is that gold is going up faster. Every chart looked like this. Real estate looked like this. The stock market looked like this. Everything in Weimar Germany looked like this, except gold was going up at a factor that was greater than all the other things. So it was gaining in purchasing power during this. And it was in my first book. Go back to the Japanese yen chart one more time, the tab before this.
Math.
And Japan has been stuck in basically a deflationary environment or stagflation during that whole period of time. Prices of real estate and stuff are not keeping up with gold. If gold quintupled, it's probably tripled or quadrupled in purchasing power of real estate, businesses, and anything else you want to buy. Cars have not quintupled since 2007. So that's a real good measurement. How much is a car since 2007? Has it doubled? Well, that means you can get 2.5 times more cars with your gold. Than a year. That's since the beginning of the year. So we just started the 9th month.
Yeah. Yeah.
Is there anything else going up this fast? And the answer is no. It's at this point for this year, this has the greatest gains in absolute purchasing power, and that is what matters is value, not price. And so we're looking at the price. It's up $1,000 this year. But is anything else up 48% this year? Not real estate, not stocks, not Bitcoin, nothing. And so that means that this is gaining in purchasing power against everything else.
Both governments and businesses are gravitating for hard assets like gold and silver due to pressures from debt, war expenditures, and currency devaluation. History tells us that true worth endures while fiat regimes inevitably fail. Gold is outperforming almost everything, and manipulation flaws are already visible, so the trend toward material wealth is quickening. Do you believe that governments will be able to conceal inflation this time, or will hyperinflation erupt like it did previously? If governments and large corporations began hoarding silver, how high could it actually rise? Feel free to share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.
In the bust, most assets are going to go down other than treasuries. But so gold will correct. If 4,000 were the high, and it may not be, could just as easily be 4,500, but if 4,000 is a high, you could be back to 3,000 or below in the bust. People want a target in the bust. I go, we don't even know what the high is on the way up. So, but it'll get hit by, 30% or more probably. Silver, if my target on silver is 75, if we correct from 75, that is more volatile, so that could go down, back into the below 30 or back into the 20s. So they're not going to be straight lines. In both cases, I think this is important. In both cases, in the post-bust era, which is 2027 and beyond, I believe you'll see gold probably in the early 2030s, and silver, same time frame, gold to 20,000 and silver to 500. So
the outlook suggests that during a coming bust, nearly all assets except treasuries could fall sharply. If gold peaks around $4,000 to $4,500, it could correct by 30% or more, potentially dropping back near $3,000. But Goldman Sachs says gold could hit $5,000 under scenarios like political threats to Fed independence. Meanwhile, silver, being more volatile, might fall even harder. If it reaches $75, a correction could send it back below $30. These moves won't be in straight lines, but in the long run, especially from 2027 onward, the forecast is extremely bullish. Gold could reach $20,000 and silver around $500 by the early 2030s. David Hunter, a precious metal expert, points out that gold recently broke out of its consolidation range around $3,300 to $3,400, pushing to new highs, with targets now raised to $4,000 and possibly higher. Goldman Sachs warns that gold's price could increase dramatically if the Trump administration's attack on the independence of the U.S. Federal Reserve is successful. They say that would trigger a flight from traditional safe havens, assets people run to when markets get shaky, traditionally, the U.S. dollar. Forecast already predicts gold reaching $3,700 by the end of 2025 and $4,000 by mid-2026. The result of their expectation that central banks will continue their current gold buying spree. On the other hand, silver has been even stronger, up nearly 50% since April compared to gold's 21%. David mentions key drivers include a weaker dollar, falling interest rates, geopolitical tensions, and heavy central bank buying, all reinforced by strong momentum now attracting institutions. The dollar, down from 110 to 97, could drop further toward 82 in steep steps. With the Fed just beginning a rate-cutting cycle that could bring rates near zero over the next 18 months, both gold and silver still have significant room to run despite cautious sentiment in markets. As we start the video, don't forget to hit the bell icon and subscribe so you don't miss any updates. Please give us a thumbs up and leave a comment below if you enjoyed the article.
absolutely, and I do say gold was in a consolidation from basically April till recently, and it broke out, from 3,300, 3,400, broke out here, and we're at new highs again. I raised my target to 4,000 last year, or not last year, I think a couple letters ago, and I'm not going to be surprised if that proves to be low, more conservative. So I'm very bullish gold here. I'm even more bullish silver. Silver's had a great run. It's up. I just did the numbers yesterday. from April to now, gold is up 21%, I think, and silver's up 49%. So it's quietly, people haven't really noticed, but it's quietly outperforming gold as it does in a bull market. So I think silver has a long ways to go. Gold probably has a good ways to go too. So I think the weaker dollar is certainly part of that story. Lower interest rates is certainly part of that story. You know, global unrest and global uncertainty is certainly part of that story. And the central banks around the world gobbling up gold is certainly a piece of it too. So, and then the final piece, which people always underestimate, is the power of the momentum. You know, it's all of a sudden the institutions are starting to notice gold, even though it's been running for years. You know, because it's got that momentum now, they're starting to say, hey, we have to have a piece of gold in our portfolios. Not at all. I mean, the dollar's fallen from, you know, basically 110 to 97 in a matter of a year, probably, or less. And I think it's my target is 82. That's far below here. It'll happen in some pretty steep steps. So the first step down in, you know, the mid 90s, and then you consolidated here. I think the next step down takes you down through 90, and then the third step down to 82. So I'm not surprised at all. You have to go through consolidations when you have such a big decline. It then goes the other way for a little while. You have to convince some of the people that were jumping on the bandwagon, but not with conviction, that whoops, this thing's going the other way. So I think we've just pretty much gone through that consolidation, and now we're beginning the next leg down, and I think it could happen pretty fast. Well, think about that. I think that tells you the sentiment that's on the street. Everybody's got including yourself just there, everybody's got a foot out the door saying, when do I exit, right? And so what we've had here, we're just beginning an easing cycle. If the Fed is truly just beginning to cut, and that there's going to be many, many cuts between now and the end of next year, where you could see the Fed fund rate go from, 4.25 here down to even zero. They don't know that yet. They have no idea that's what's coming. But if in the next 18 months, that's what you're looking at, and you're early on in that, and you're at a point where it doesn't look like the economy's falling out of bed, gold's got a ways to run. Silver's got a ways to run. The stock market's got a ways to run. And yet everybody's getting nervous here rather than bullish.
A few years ago, David called for a major market melt-up, and has steadily raised his targets as conditions improved. His S&P 500 target has climbed from 6,000 to 8,700, with Nasdaq at 30,000 and Dow at 60,000. He views this as the tail end of a long bull cycle that began in 1982, likely topping out soon, but still with strong upside left. Despite a slowing economy, falling interest rates and steady earnings are fueling gains. Interestingly, retail investors have stayed confident and bought dips, while institutions were more cautious and even bearish, only now starting to turn more aggressive as they see the market's momentum. Let's look back at the interview.
Probably 3 or 4 years ago, because I was calling for this melt up, and I get accused of raising my targets constantly. I go, that's what you do. As the evidence proves it's got more, there's more things saying it should go higher, you raise your target. So, I started out at 6,000, or even before that at 4,000, but I've raised it to, 7,000 and 7,500 and 8,000, now 8,700 on the S&P. And same thing, I've raised my gold target a few times. But it's the case that this thing is a big historic bull market, and you just gotta stay with it. I'm sorry, I lost my train of thought of what you would. Oh, we were talking about the VIX. Several years ago, I said the VIX could go to 10, and that was when it was in the 20s. And I said if we've got, and that was when I thought the market might go to 4,800 or 5,000. I still would say that the low on the VIX, I think, is down just below 10. I think that's probably where we're headed again. So everybody gets worried when it gets down at 14, 15. I go, it can keep going, and there's no magic at 10. If it wants to go lower, it's really, it's a trading vehicle. There are times when it, the market goes through a swoon and it bounces back up over 30 and maybe over 50. But other than that, I don't use it at all to say this is the top in the market, because it can go lower. We are, as I've been saying for a long time, I think we are late in a long cycle, a bull market cycle that started back in 1982. So this is the 43rd year as of August of a bull market cycle that I think is coming to an end. I expect to see, we probably could top out by the end of this year or sooner. But we've got, I raised targets back in April when we had Liberation Day and everybody got bearish. I raised my target to 8,000 on the S&P. From there, in my July investment letter, I raised my target to 8,700 on the S&P, 30,000 on the NASDAQ, 60,000 on the Dow, and the Russell 3,400. So I obviously think there's still a lot to go here, even though I think it's going to happen pretty fast. It is late in the game. We've had a long cycle. The economy is slowing. We may, in fact, already be in recession, but at this point, the evidence is not building to something that says I'm calling for a global bust next year, as you know. But the evidence right now allows most investors to see this as a soft landing, and earnings are still intact. So basically, you've got the best of both worlds: slowing economy, what I think are going to be declining interest rates, and earnings still growing. And that's music to the ears of Wall Street. That will get all the skepticism that's built up on Wall Street. They've fought this market since 2022, all the way up. You're starting to see them begin to say, "Hey, I gotta get more aggressive because this thing has legs." People, it's not that institutions go all in or all out. They're probably not very much in cash, but they're more defensively positioned. They have been skeptical towards the market. You're right. The retail investor, surprisingly, when we had that swoon back in April, they stayed in the market pretty much, and said this is a buying opportunity. It was the institutions that jumped on the bear market bandwagon and said, "Oh, we're going lower. We're going a lot lower." Strategists across Wall Street were lowering numbers and talking about 4,000 or 3,000 on the S&P. And it was surprising to see the retail investor stay basically on board and bought down there. Like I said, at the very bottom of the sell-off in April, I raised my targets while everybody else was lowering their targets. So, kudos to the retail investor that they this time were the smart money, and it was the institutions that weren't so smart.
Both gold and silver are showing powerful momentum, supported by central bank demand, a weakening dollar, and shifting global policies. While sharp corrections are possible if gold peaks around $4,000 to $4,500 and silver near $75, the long-term outlook remains extremely bullish, with forecasts of historic highs by the early 2030s. At the same time, equities may still have room to climb, even late in the cycle, as falling interest rates and resilient earnings continue to provide fuel. If a sharp correction does occur, would it present a buying opportunity for long-term investors or a warning sign of deeper risks? How much influence will central bank gold buying have in preventing deeper pullbacks in the years ahead? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us, and wait for the next updates.